Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, after weeks of conversation on the subject and weeks of speculation, it has finally happened. Fannie Mae and Freddie Mac are in the hands of the federal government now, and we have assembled our panelists once again to see how they view this takeover situation. Also on the minds of investors is the stock market during a political year. The candidates here weigh in on that issue also. Joining me at the round table, as always, Steve Reitmeister, editor-at-large for Zacks.com. And next to him, the vivacious Tracy Reinick. Tracy is our value stock analyst for Zacks.com. And a round table wouldn't be a round table without the maestro himself, Kevin Matris. So, is this a surprise to anybody here that Fannie and Freddie got taken over? I mean, let's not forget that Mr. Paulson and Company, as late as a couple of weeks ago, and we're taping this on the 8th of September, for those who are keeping track of the calendar, had said, don't worry, they're solvent. They have a lot of cash on hand. And in fact, they did have a lot of cash on hand. This is not another Bear Stearns situation in that regard.
Yeah, is it a surprise that they're taking over? That's a partial surprise. Are we surprised that they're backing them up? Here again, what is backing them up versus taking them over? Okay, so both were, that the full credit and faith of the U.S. government was going to be behind them. That was a certainty. So now taking them over, that's a little bit of a surprise. You can see a market surge on that information, but it's already dwindling back as we speak here. Mm-hmm. And that tells you a bit about what people think about it. It's like, okay, that's nice, the government's behind it, but then hold on, wait a second. That means there's a mess, right. Okay? And what other mess is out there? And that's why I think the market's retreating from this news. Okay. So, Tracy, what could the mess be? I mean, they have money. It's not like they don't have cash.
They do, but apparently J.P. Morgan was in there investigating more deeper into their books, right, and found things that were even scarier than what was maybe already known out there. And I think, part of the unknown now is what did they find, how bad was it, what made them go in right now.
Maestro, is this a good thing?
Yeah, I mean, it turned out that they had enough money, or at least that's what they kept saying. And apparently they still did have enough money. They were over the capital requirements, but they didn't have the margin of error like everybody, I think, thought they did. But I think the Fed coming in, or the government coming in and being able to provide this bailout is good, because I think a lot of people were becoming unwilling to continue to buy their debt. And by being able to have the government come in there, put together a plan that instills confidence, they're going to go in there and continue to buy their paper. This should bring some liquidity to the market, and overall it should help things. But I'll tell you, the one thing I wanted to say, I believe the government has come in and done something similar to this. I think they did something with Chrysler many years ago, and they did something with Lockheed Martin, and everybody is wondering, how much is this going to cost the taxpayer? If everything goes according to plan, it could come out and not cost us anything. In fact, they made money on Chrysler. They made money on the Lockheed Martin deal. We may be able to see the government come out of here, make a little bit of money, and not really cost us anything except for the shareholders.
So how do we buy stock in the government? That's what I'm kidding. No, I'm kidding. I think an interesting comment from our roundtable that we had live over the weekend was about Andy Zimmer saying about how the government is going, the government should find a way to release the risk over time.
Right.
Okay. If Fannie and Freddie were on their own, it'd probably be a lot scarier. We would see mortgage rates go up much higher, the loans not being made, and therefore the cost of homes come down faster, creating a bigger scare. The fact is, let's not kid ourselves. We'd be paying for this one way or the other.
Right.
Whether even the free market handled it and the way the risk gets dispersed, we'd all be taking a piece of that. This does it in a more orderly fashion. We're all going to take our lumps. It is going to cost us one way or the other. And this was a more orderly way of doing it without there being a mass panic if Fannie and Freddie had to go it by themselves.
Right. And time is what was needed because they're going to be increasing the portfolio for both Fannie and Freddie over the course of the next year and a half. Then they're going to start scaling back. So as more time is added to be able to get ourselves out of this mess, that is what we need, time and this additional liquidity.
And for those viewers who don't know that we did a live roundtable a couple of days ago, I will just clarify that, yes, at a Chicago hotel, a couple of days before this taping, we had a live edition of this roundtable.
Well, I wanted to say one other thing. One thing that was a little disturbing to me was that Paulson this morning said he didn't know how much it was going to cost. He has no clue.
Well,
it seemed to me.
Right. Here's
and
another
so that's
thing.
a little bit disturbing that the government goes in and they don't know.
Well, that's probably the honesty of the situation because they keep thinking they know as we go along, but no one knows how bad it's going to be because here again, there's also the contingencies of, well, how many of these loans are going to go bad? You have to know each person individually in order to figure that out.
But here's another thing that I would think the market is going to focus on. Not long ago, Mr. Paulson outlined the new terms for government intervention. When does the government, when is it an institution too big to fail? When are they not big enough? And, then who cares? So does that call these rules into question all of a sudden? Is the market going to look at this and say, hey, wait a minute, is he changing the rules for his friends or for certain entities and not others?
If there was a time to step in, this was it, okay? 3/4 of the loans that are out there are originating or backed up by these organizations. Here again, the problem was that they were allowed to have that much market share. What happened? So one of the things that will be interesting from here is, yes, the government is going to help clean up the mess, have the risk dispersed in an orderly fashion, but now what? I don't want these two organizations in the same framework they were. I don't want them having anywhere even near 30% of the loans originated in the future. I want to see here a little more of a free market kind of status. Break them up like AT&T. Okay, break them up and let more organizations be part of this party, and I think it will work in this modern world.
And that is what's going to be interesting because nobody has fleshed out the details. It's true their portfolios are going to be allowed to balloon over the course of the next year and a half, but then scale back. Well, who's going to take responsibility for all of those loans? So that'll be interesting to see how these details come out.
A lot more to come.
So just to clarify, at this particular juncture, am I hearing from each of you that this, on the surface, seems to be a good thing for the market?
Yes, but that doesn't mean the market rallies and rallies and rallies. It just means it's better than the alternative.
Right.
Okay. All right, and then the next issue, the partisan stock market. Everybody's been kicking around this whole notion of does the stock market favor one political party over another? And there's another research firm out there that has constructed two market averages out of how the Dow has performed in past presidential election years. In fact, back to 1900. And the first of these two benchmarks tracked the market's average performance during years since then in which the incumbent political party eventually won the White House, while the other reflects the average return when the incumbent party lost. And there's part of this theory that brings it all down to the month of September, which we're in right now, that the way the market performs in September dictates whether it's the incumbent party or the other challenging party that takes office. What do you think of that? A lot of background.
I have to admit, when we first talked about doing this topic, and before I saw the numbers, I thought it was all hokum. Okay, that there was nothing to it. This is the kind of things that people throw around. In all the data, we got a few pages of data here about what happens when it switches parties, what happens when the same party stays in office, and all these things, what happens before and afterwards. I have to say the only one that does seem to stand out is that after the election, there is a few point advantage to a Republican Party being in office. I would say I would not trade that information. I would stay away from it. But I'm saying if there was one little grain of truth from the past 27 elections that they have recorded in this information, there is like a 3-4 point advantage in between Election Day and the end of the year when the Republican Party stays in office. But here again, I would call that not tradable. There's not enough data points for me that you could take out a couple of the events and say, oh, they're about the same. A couple outliers. So slight edge to the Republicans, but I wouldn't trade it.
Tracy, as a fundamentalist, do you look at that the same way?
Yeah, I don't put much stake into the numbers because there's numbers all over the place too. Like we're discussing the September data, but there's also August to October, and then you could look at anything, basically, and say that this proves this or...
And Maestro, you, of all people, who pay a lot of attention to charts and graphs on, the market macros,
right.
How do you look at something like this?
If you were to take a look at all of this data, by and large, it comes out to be, for all intents and purposes, a statistical wash. But the one thing that I did find that was interesting, out of all the pages of stats we were looking at, it says that when the Oval Office stays Republican, the first year's return is 8.2%. However, when it switches from Republican to Democrats, it goes up 13.7%. However, though, they say that number is skewed because of the 64% gain we saw when Hoover took over from, or FDR took over from Hoover. Mm-hmm. So if you were to exclude that one anomaly, the switch from Republican to Democrats, you're up only 1.2%. But the point of the story is that it looks as if the first year of whoever gets in is probably going to be higher.
That's true. And also, I believe there's another strong point here is the market hates uncertainty. Right. I think whoever wins, I think you see a market rally the day after. It doesn't matter what party it is, because the uncertainty is gone. Okay, we have a new party in office. Let's just get back
to no more hanging chads.
Right. let's hope we don't have anything like that, and let's just get back to talking about the economy and where this thing moves forward. Right. I think market rallies regardless of who gets in.
There's actually some interesting data that shows if the incumbent party loses in November, the markets rally 2.5%, and if they win, it only rallies 0.4%.
Interesting. Do the markets favor incumbent parties or challenging parties? The world may never know. With everyone here at the roundtable, Steve, Tracy, and the Maestro, I'm Terry Ruffalo.